Shri Mukesh bhai, we are very keen to hear you. Of course, some significant or some not significant so far as the individual taxes are concerned, but certainly something coming from nowhere, the virtual assets and the compliance, voluntary compliance. We would be happy to have your analysis, sir. Please, over to you, sir.
Thank you. Thank you very much, Saban Bhai. Good evening, friends. The FM in the budget talked about digital India, talked about digital economy, and therefore, no wonder, Bakul Bhai, today we are delivering our budget analysis also on the digital platform. It's online when we are able to reach out to friends here at AMA in Ahmedabad, all over Gujarat, all over the country. And Bakul Bhai, in fact, this year the feedback and response has been that there are so many friends watching us around the globe as well, just as the budget is being watched about. Well, friends, Divesh Bhai and Saban Bhai mentioned to this very historic occasion of the AMA budget, which is into its 42nd year. I think, as we always say, FMs may come and FMs may go, but we go on forever. And this time, we are here to talk about, as he had to speak, of course, there were more tops than flops, from the budget docs. And I'm supposed to talk about the chills and thrills of the finance bill. But before I come to the finance bill, I would like to agree to disagree with Bakul Bhai's some points, And we often get into this jugalbandi also. He was of the opinion that the common man really did not need any relief. And he talked about cricket, and therefore, Bakul Bhai, talking in the parlance of cricket, you talked about 20 runs in 1 over. Here, there have been 4 balls in an over, and the over is still maiden because it's the only 1 over. In fact, you don't even have 6 balls. You have only 5 balls to play. And the batsman, that is the taxpayer, is not given any opportunity whatsoever to score even a single run. Not a rupee of relief. Let me point out, I would like to just take a couple of minutes to meet with some points that were raised by Bakul Bhai before I come to the finance bill. Let me first of all say that as far as the budget is concerned, and it being historic on the economic front for the nation, it's a budget for investment and growth, BIG, and therefore it's a big budget, no doubt about it. But then, when it comes to the common man, and let's not forget, Bakul Bhai, the common man, yesterday, in the lighter vein, somebody was saying, and very aptly so, कि गरीबों को मिली सब्सिडी, गरीबों को मिली सब्सिडी, अमीरों को मिला रिबेट. आम आदमी, तुम टीवी देखो, तुमको मिला डिबेट. I think the common man is trying to find what is it in store for him. And Bakul Bhai, let me try to just point out that this buoyancy in the revenue is not because the real income of taxpayers has gone up. The revenues have gone up because of better compliance, voluntary compliance, because of the system, I would say, the faceless assessment. the artificial intelligence, the annual information statement. These are the drivers for the buoyancy in the revenue. Of course, the economy has done well. But just because the economy has done well, that does not mean that the common taxpayer and his household budget is comfortable. Let me point out, friends, that if I just take 5 of the key deductions, salary, standard deduction, ATC, savings and investment, your limit of 1,50,000, your Mediclaim for both seniors and non-seniors, your bank interest. If only I take these 5 things, I find that on none of these fronts during these past 4 budgets, a penny of relief has been granted. There has been, I don't propagate for raising of exemption limit because then you erode your tax base. I want the taxpayers' base to grow. But I would have loved, friends, if the finance minister had made it a win-win situation. On one hand, it would have been a budget for infrastructure, for growth, for all-round economic development, and she would have given opportunities to the taxpayer to participate. I didn't want only tax, refunds to come or reliefs to come to promote consumption. What you could have done is you could have said, okay, we are raising your ATC limit, and here is an opportunity for you to invest into instruments where the government itself is attracting, investment from all over. Why not from its own taxpayers? And in return, if you borrow, you would have given interest. Here, in return to your taxpayers who are parking their funds into the nation's economic development, you would have given them some tax relief. You could have said that, okay, we are trying to give. In fact, this is what I have always been propagating. There are countries in this world, friends, in the global economy, there are tax systems which have an inbuilt, at least for a few elements like your standard deduction, etc. The moment there is a rise in your cost inflation index, there is a rise also into those limits. Now here, as I said, for years together, 5 years, 7 years, 8 years, 4 years, all these limits, they've been static. And if I just take 4 years of the FM from 2019 to 22, the consumer price inflation index is on record, Bakul bhai, 15% inflation. Now, and you are projecting another 5% this year. So in 5 years, if one has to bear the brunt of 20% inflation and with no tax saving whatsoever, not even an opportunity to participate in the nation's growth and economic development, well, I think the pinch is always there. See, last year it was COVID. As a disciplined soldier, the common man said, I'll stand by. The FM, I don't expect anything. But this year, there was a close to 30% revenue growth. It could have been possible to align it in a win-win situation. Unfortunately, that has not been done. We still have 1 more year to go, and let us hope that it comes next time. With these opening remarks, may I now come to the Finance Bill 2022. In fact, as far as direct taxes is concerned, when the FM started with her Part B, she outlined the main focus, quoting from Mahabharata, and then what a tax administration should be, what should be the tax entire system of revenue collection, she highlighted, and rightfully so, 5 chief goals, starting from the stress on voluntary compliance, the simplicity of the tax system, a trustworthy tax regime, a system that reduces litigation, and obviously, overall in the budget, she had been talking, so the tax system could not have been the horse of that, that is ease of doing business. Now, we will need to actually analyze, because there are very little of incentives, we will need to analyze the budget proposals on this test stone of these 5 parameters. And there, while there are some very welcome provisions, there are some irksome, I would say, thorns, in the rose that the FM has offered. And these tax thorns, if they are not taken care of, I think they will frustrate, these 5 very laudable goals of starting from the ease of doing business to the trustworthiness, the voluntary compliance part, the simplicity of the tax system. So let me quickly run through, because this is exactly a day after the budget, and therefore you would very much want to first have a flavor of what are those key highlights of the finance bill. Let me run through that, and within the framework and constraints of time, I will try to focus on some of the areas which need more elaboration. Coming to personal tax, friends, as we all know, obviously the income tax slabs, rates, surcharge, cess have remained unchanged except for, and the common man again felt the pinch here, because the only beneficiary of that bit of relief that came, which, let me tell you very honestly, I have been a strong opponent of surcharge. When this surcharge of 25 and 37% came, I used to say ki sar se badi pagdi, 37% on a 30% tax. So 37% had no business to stay. Well, it is still there on the other income, but as far as capital gains is concerned, as you are aware, friends, 111A, section 111A for short-term capital gains on listed securities and 112A for long-term capital gains on listed securities where STT is paid, there was a cap of 15%. So the only capital gains that were left out were under section 112, the long-term capital gains, arising out of any shares of private companies or maybe debt-oriented instruments like units of mutual funds, etc., or when you sell any other capital asset like land, building, gold, jewelry, etc., in respect of all these assets, the long-term capital gains are taxed, as you know, at 20% under section 112. But because of the surcharge, if somebody has income above 5 crores, the tax rate used to go up to 28.5%. And even if you were above 2 crores, it used to go up to 26%. Fortunately, now this 26 will come down to 23.9, and 28.5 would also again come down to 23.9 because 15% would be the cap. So the net relief for anybody over 2 crores would be 2.1%, and above 5 crores would be 4.6%. It can be quite significant. So what I would say is this provision comes into effect from 1st of April, from the new financial year. So if you have any plans starting after this 1st of February, when you have been given notice to sell any valuable property or assets where you are going to get substantial gains and you are going to be in the bracket of 2 crores or 5 crores and above, well, wait until 31st of March. It could mean a lot to you. Because even if it's 10 crores of gain, you would save a healthy 45 lakhs. On the few small reliefs on personal tax, these announcements were made. They've only been formally legislated. And that is in regard to the monies that an employee has got from his employer or any other person, in case of either medical treatment on account of COVID or in case of a death, where he is getting, the family of the deceased is getting support from the employer or any other persons. Now, fortunately, there are no monetary limits. There are just some rules. As far as the employer is concerned, there is no restriction. As far as other persons supporting the employer's family are concerned, there is a 10 lakhs ceiling, the maximum amount that you can claim as exempt under Section 56. So under two different provisions, under Section 17, for what you get from the employer is not treated as a taxable perquisite. Under Section 56, whatever you receive, because the employer in any case is not a relative, or from any other person, maybe some charitable trust or foundation, etc., that of course comes under 56. But suppose you have friends of the family who are supporting you, all this will be exempt. There is only a rider, and I don't know why this rider has been kept, but it says that you should, to claim this exemption, you should have got the monies within 12 months of the death of the concerned deceased. Now, what happens if it is beyond 12 months? Why should there have been a restriction? I am unable to understand. As far as, and this is applicable from the financial year 1920, assessment year 2021, as far as the contribution to the National Pension Scheme is concerned, you must be aware, friends, that the provision came as far as central government servants are concerned under Section 80 CCD, that the employer's contribution to the extent of 14% would be treated as a deductible item, in the sense you would not be required to pay any tax on that. Similar provision, was extended to state governments. State governments were still taking time. Some have, implemented it. Some are yet considering that. But with effect from financial year 1920, assessment year 2021, retrospectively, this has also been extended to all state governments. It's a small provision, but nonetheless welcome in principle. 80DD, where you have a straight expenditure that is incurred for a handicapped dependent, then obviously, you get the deduction. But in case of a policy that is taken, where there is an annuity or a lump sum, there was an element of taxability, and that has been relaxed, and it has been provided that even if the annuity lump sum is received by the disabled dependent on becoming a senior citizen at the age of 60, as far as the policy holder is concerned, who has taken out the policy for the disabled, the physically handicapped person or mentally handicapped person as well, that would not be taxable. That is a provision that has been incorporated with effect from the coming year. Now, talking about tax rates, friends, cooperative societies have been a beneficiary in certain respects, because there the alternate minimum tax, which used to be 18.5%, has been lowered to 15%. As far as AOPs are concerned, where there are consortiums of corporates, there also the surcharge has been capped at 15%, just like as in the case of long-term capital gains. There are certain incentives, particularly under two sections, and I think they would indeed be very welcomed by the corporate world because of the lull in the economy on account of COVID. You may have had plans and you might not have been able to start in time. Therefore, Section 115 BAB, which allowed you to get the 15% concessional rate of tax. If you go into production, the initial date was before 31st March 23. That has been extended to 31st March 24. And similarly, for startups, the extension has also been given under Section 80 IAC for one more year. Capital gains, there are one or two very interesting provisions. Of course, it's a consequential change. The reduction of goodwill from the block of asset is to be considered as transfer from the assessment year 21-22. But then, one of the provisions, friends, which you have to keep in mind, and there you have, if at all, for this year you are still safe because there are a number of provisions in the finance bill which have been implemented or given effect to from this very financial year. Fortunately, this anti-avoidance provision is not retrospective in the sense it starts from the 1st of April of 21 and covers up to 22, but it will come into force with effect from the 1st of April 23 for the new year. And that is bonus stripping, as we all know. Now, we already had the provisions of Section 94 under the Income Tax Act, where, dividend stripping was covered. And even in respect of units of mutual funds, you had this loophole plugged as far as this bonus is concerned. But shares of companies, for years together, and I don't know why, they were out of this bonus stripping provision anti-avoidance regulation. They will be now, with effect, means after 31st of March 22, they will all be covered. So until then, if during these 2 months, now even the finance bill is legally validating the bonus stripping part because it says that it come into force only with effect from the next year. There are a series of amendments which have taken place as far as business deductions and allowances are concerned. I would like to very quickly run through them. My later part of the presentation, I am going to take up on some very critical issues where I have strong views on the matter. But let me run down through some of these finance bill provisions, which I think should be more of information and education for you. Now, there is a provision. There has been, I read in the papers today, there has been a scare that, you will not get the benefit of Section 80G deduction if the trust or the institution does not upload, the statement giving the details. Now, let me clarify, this is not in regard to 80G or 80GG also. This is in regard to the provisions of Section 35 of the Income Tax Act, where 100% deduction is allowed in regard to sums or contributions that you make to research associations, university, college, etc. And this is an amendment which is applicable from the last year because the government expects, the ministry and the department expects that whatever you are claiming should have been duly reported, in the format as they were required to. As far as 80G is concerned, friends, it is now getting into the legislative mode with effect from the coming year. And therefore, you will need to ensure that whenever you file your next tax return for the assessment year 22-23, for this year, all the charitable trusts who have received contributions or donations, will need to, it's something like this. If in your form 26AS, or now what we know as AIS, if there is no entry appearing in regard to a TDS or TCS that has been made in your case, you will not get credit. CPC will not give you credit. Similarly, now it will be important for you, if you are claiming any benefit of deduction in a Section 80G, you will need to ensure that this is duly reflected, in the reporting. So that was the first point. The second point, and which of course is going to affect in a big way several pharma companies. There have been two kinds of pharma companies. There have been pharma companies who have been disallowing on their own voluntarily the freebies, as it is referred to in the world of pharma, because the medical council regulations are that if you are giving any incentives or gifts or special benefits to doctors, etc., it is against the rules of the medical council, and therefore the departmental circular and the view was that such expenditure should not be allowed. Incidentally, there were decisions of various tribunals on both the sides, for and against. So finally, it was decided that, well, they will come out with a clarity on this, and beware, it is going to be effective from this very fiscal year. So 10 months have gone. If you have not taken it into consideration, if you're a pharma company, please keep in mind that you will have to ensure, because it says that if there is any expenditure for any purpose which is not permitted by the regulations of, any particular professional council, etc., or it is for any offense prohibited law, because people used to do compounding and they used to take the benefit, and similar provisions, such expenditure will not be allowed to the businessman. And particularly in regard to the benefit or perquisite that is given to your own, this is something which I think I should take a minute or two to explain. You will need to be alert, because there is a provision which fortunately, obviously, though the disallowance provision is coming this year as far as pharma, etc. is concerned, but there is a provision under the Income Tax Act in Section 28(4) that if there is any person who is carrying on a business or profession, Section 28 subsection 4 requires that your provisions of deemed income will include such benefit or perquisite that you receive in the exercise of your business or profession. Now what happens, there are agents that you have, there is nothing as far as law is concerned, just as pharma companies deal with doctors. You may have, as a businessman, you may be dealing with your agents and various other parties, and it's very customary that as a measure of sales promotion, you may be giving out gifts, you may be taking them out for various foreign tours, etc., as sales promotion. Now, sales promotion, if it is not against the provisions of law, it will be allowed as an expenditure, but with a view to ensure that the recipient of the benefit gets this, because there are special schemes. You are told, okay, if you achieve this number, you will be given a car. Now, there is a new section that is introduced with effect from 1st of April 22. That is Section 194R. Sorry, 1st of July it will come, because it's the procedural provision. 194R, and that provision says that just as you are required to deduct a 10% that you pay to a professional by way of fees, here, whether it is in cash or it is in kind, you would be required to make a 10% TDS on the value. And the section also says, suppose you are giving a car. So obviously, where is the money? How would you deduct? So it says that before you give out or make that expenditure, you will have to ensure that adequate provision is made. Now this is going to really create a lot of embarrassment for businesses or professions, who dole out, these kind of special incentives for promoting their business, because the view now would be that in order that the income is being shown by the recipients under section 28(4) and a proper tracking is done, 194R will play its role. And if as a deductor you have not discharged your obligation, then you yourself will become liable to pay this out of your pocket. So this is something which will have to be considered, provisions of 194R. Again, something which may not be very comfortable in terms of ease of doing business. In fact, so many friends keep on saying that every year TDS and TCS provisions and the nets are widened. And the government, in fact, that's the biggest single source of revenue, the deduction at source, the withholding taxes, the collection at source, and for which, you have to incur so much of expenditure. It is not always very comfortable. I know companies have to keep departments all together. They have to incur a lot of expenditure. Banks give services to the income tax department for collecting revenue. They get commissions. I wish there was some provision that corporates who are efficiently managing their TDS affairs and who are required to spend for that, at least they are given some kind of an incentive as well, because they are ultimately doing a service to the income tax department. Friends, there is another provision which has also been introduced, and that is that the cess levied on tax. You are aware of the health and education cess, which is currently 4%. It used to be 2, 3, then it came to 4 now. Certain courts had taken a view that this cess is not in the nature of tax, because section 40 of the Income Tax Act provides, as you must be well aware, that tax that you pay, whatever it be, is not deductible, particularly for earning income or conserving your wealth. So income tax and wealth tax have never been allowable deductions. But a view that came up was that cess is something different and it should be allowed. There was this High Court view. The matter was pending in the Supreme Court, but the government has taken a firm stand, and it does not do this very often, but here they say that this amendment will be applicable retrospectively from assessment year 2005-6, 16 years back. So, but to be very honest, I had always been advising corporates that this is the last thing you would want to do. But then many times you're tempted because there is some decision which may not be necessarily the right decision, but then you get tempted to make a claim. So you will have to be at the receiving end, in case you have claimed it in the past. 43B, a provision is conversion of interest payable into debenture or any other instrument not to be deemed as payment of interest and shall not be allowed as business expenditure. So 43B, that provision is there, which is coming from the coming year. Friends, there is a provision as far as corporates are concerned who are receiving dividends from abroad. So foreign dividends, you had a concessional rate of tax, particularly where the holding of the corporate was more than 26%. So that used to attract a concessional rate of tax of only 15% and 115 BBD. Now that has been decided to be withdrawn. So such foreign dividends will now attract the normal tax. You have to keep that in mind. What is going to raise a big amount of litigation, in fact, almost all courts were unanimous on this, and even Supreme Court had given its verdict that as far as Section 14A is concerned, My friends from the profession and even taxpayers are mostly familiar with this, that 14A says no deduction would be eligible in respect of expenditure incurred in relation to exempt income if there was no exempt income which had accrued or been earned during the year. Now, the departmental view is that even if you have not earned any exempt income, according to the formula they have under Rule 8D, they say that automatic disallowance must be there. Now, this is going to create further litigation, but you will have to be watchful. Of course, if you are able to take a stand that, the 1% formula does not necessarily apply to you and you are able to identify or quantify what is that small expenditure, it would be wise to do that, practical and prudent, and you can smartly get out of the situation. Friends, as far as search, seizure proceedings, etc. were concerned, against income which was identified there, people used to do mischief by trying to book losses and set off against such undisclosed income, losses, unabsorbed depreciation, etc. So it has been provided under new section 79A that there will be no set off of any such losses or unabsorbed depreciation. Well, friends, I am just about a little over halfway. I would like to now take up one or two very sensitive points. I think these are really irksome. And when I said that the ease of doing business, or FM is talking about reposing confidence in the taxpayers, making the tax laws simple, the system stable and predictable, these are a couple of provisions which are not going to work in that direction. And one of the most disturbing provision about which there was no reference to the FM speech at all. In fact, I am not even aware whether she knew about it, that there is some such provision in the bill. But a very notorious, mischievous provision, with due respect, I would say, has been introduced. Now, those of you who are aware, we have Section 68 of the Income Tax Act, which deals with cash credits. The word is cash credits. It necessarily does not mean, it could be the credits could be coming by check also. But anything that you credit in your books of accounts is referred to as cash credits. And the simple rule is that if there are such credits, and they could be either by loan, borrowing, they could be, in the form of share application monies, etc., against which you allot shares. If such monies are credited into your books of accounts, and during the course of the assessment proceedings, the assessing officer asks you something about that regarding the explanation for the source thereof, and the section says that if during the year there is some such credit in your books and you are not able to explain the source, or if the explanation offered by you is not found to be by the assessing officer to his satisfaction, in such a case, this amount, which is added as cash credit under Section 68, it is treated in the nature of your undisclosed income or investment, and therefore, under the provisions of Section 115 BBE, it attracts, I would say 84% of tax and penalty. You'll ask how? Because there is a flat rate of tax of 60%, double the 30. There is a surcharge, hefty 25% flat, which makes it 75, 60 plus 15. Then there is the 4% cess, which would make it 78. And there is under Section 271 AAC a penalty of 6%, so that would take it to 84. And if something comes to be added in your assessment, by the time the tax computation, etc., is done, there would be interest also. And if you add the interest to that, it could well go up more than 100%. There have been several instances. So this is a provision, which had to be handled with care. Unfortunately, it has been tampered with this time on the ground, because the memorandum explaining the provisions of the finance bill says that there are taxpayers who are trying to use loans and borrowings in a mischievous way to bring in their unaccounted money. Now, with due respect, I would say this is a very general statement to make, and just on that, try to corner everybody just because then they are referring to certain court judgments. And court judgments, let me tell you, they've been very sound on this subject. Courts have taken views very objectively. In several courts, they have confirmed cash credits, several decisions. They've confirmed cash credits in favor of the revenue, if the circumstances are such. But the courts have laid down the principle that if the identity of the person who has given the loan or borrowing is proved, if the genuineness of the transaction is also proved, the onus on the receiver of the loan or borrowing stands discharged. And if at all the department has got anything to say, they can always make an inquiry in the other case, because the party has also given a confirmation. So there is a confirmation, there is identity, there is creditworthiness, and above all, it has come through the banking channel. If it is by cash, it can still be doubtful or debatable. But with all this, the courts have taken a very positive view. And therefore, the system was going on quite smooth. Now, the apple cart has been upset by this finance bill, and this is really, giving you a chill down the spine, and which says, it is proposed to amend the provisions of Section 68 of the Act so as to provide that the nature and source of any sum, whether in the form of loan or borrowing or any other liability credited in the books of the SSE, shall be treated as explained only if, so they put, a negative condition, only if the source of funds is also explained in the hands of the creditor or entry provider. Now, what are you trying to say? I am sitting here with Bakul Bhai, and Bakul Bhai, I receive from him a loan, a friendly loan. He gives me, says, okay, keep this amount. It's to be returned back to me. In fact, there are people who are doing business, non-banking finance companies, finance cooperative credit societies, who take from their members, who take from their constituents, customers, because the only exception is in regard to those venture capital funds. Please bear in mind, in 68, all these other genuine cases are not exempted. So what would happen, say, if he gives me something and my officer asks me that, Mr. Mukesh Patel, you explain, it's fine, you have given the identity of Mr. Dholakia, you have given his PAN, you have given his confirmation, but that is not enough. If he has given you 10 lakhs of rupees, now it is on you to explain how Mr. Dholakia got this 10 lakhs and how he gave it to you. Fortunately, they're not saying why. But the source of the source. Now, first and foremost, would I at all, it would be hugely embarrassing if I have to ask him, sir, give me your tax return, give me your bank accounts, because my officer is asking me, and if you don't give me that, my officer will add that as my income. Now, maybe, if it is not explainable in your case, they could always take action in your case. And they make independent, in all these cash credits, they have 133.6 inquiries. The department directly writes to him, saying that, have you given this money to Mr. Patel? Is it okay? What is your... So he is then duty bound to explain to the... But if I have to ask him, I think this is not done, friends. This is one of the biggest stumbling blocks to the ease of doing business, about which the FM talked at the top of her voice. Friends, how do you expect? And just imagine the plight of those who are doing this business. They are accepting money. They are, paying interest. Now, just because some of their constituents, customers, members, are not able to explain, or their explanation, is not accepted. I think this is one of the most negative proposals of this finance bill, and we will need to raise our voice against this, because it can, fortunately we are in the realm of faceless assessment, so nobody can play mischief in that sense of the term, to harass or to promote corruption. But nonetheless, if it's my misfortune and I have an officer in the faceless scheme who is not able to understand my point, I would have to go through, for whatever I have accepted, a liability of more than 100% and then fight it out. I think this is something which really, really needs reconsideration. The next, friends, is, even last year I said, whenever the FM starts the speech, they try to always get something as if it's a big trump card. And I recall last year, it was the 75th budget, because from 47 to 21, that was 75 times. So the FM, in all good faith, said, okay, I want to salute those who have attained 75, those senior citizens, 75 or 75 plus, and I want to give them the benefit of exemption from filing their returns of income. And everybody, the house, they tapped their desks and everything was great. Until we saw the documents in the finance bill, and we found what were the attached conditions. The conditions were, number one, that you should be getting pension income alone, and along with that, okay, the only other income you could have is interest. Pension and interest. To that extent was fine. But then they said that your pension and interest both should be deposited in the same bank account. So you should have only one bank account. Now it is something like this. How can you get, a person who is 75 plus, who is having only pension income, nothing else, no dividend, no capital gains, nothing, who is having interest, okay, fine, he is having interest on deposit, but he is having only one bank account, and that interest is also being deposited into that same bank account where the pension is being deposited. So the whole scheme became a big farce. Something similar to that has happened this time as well. A scheme with a very laudable objective, because the FM talked about promoting voluntary compliance, reposing faith and trust into the taxpayers by making things easy for them, simple for them, trying to ensure that litigation is curbed. Now, here, this time, as you know, you would have heard when Part B started, she talked about the updated return scheme. Now, there are two sections, Section 139(8)A and Section 140B. Time has a constraint, so I will not be able to go too deep into it, but let me very quickly point out as to why I fear that this scheme may be nothing short of a flop show. A very laudable scheme in principle, but because the way it is designed, the way it's packaged and sought to be administered, I hardly believe it is practical enough that anybody would want to go and avail of this. Now, let me give you an example very quickly, and I'll explain this point. Take, for example, now this is going to be implemented from the coming assessment year 22-23, that is your financial year 21-22. If you are a regular taxpayer, your date of filing return is 31st of July, 31st July 22. If you have not filed your return in time, then you can file it maximum belated also up to 31st of December 22 under section 139(4). And under 139(5), if you have filed it earlier and you find that there is some mistake, you can revise it. So the whole objective and idea is that now the government says, and the FM said that we have come out with our AIS, Annual Information Statement, and taxpayer, there is so much of voluminous data, he may not have been able to check and see, and therefore, if he has made some mistake, he should be allowed to correct it. But the challenge always used to be that between July and December, in 6 months, if you have to file your return, or revised return, how do you do it? Because after 31st December, you could not do anything. So this scheme brings in this very concept that, okay, under this scheme, you can go up to 2 years beyond the end of the assessment year. So the assessment year is 22-23. Under the scheme, you can file an updated return up to 31st March 25. Now, what are the provisions? The provisions are that if in the very first year, that is up to 31st March 24, you file it, there is a certain rate of tax, and whatever you have to pay, additional tax they call it. And then in the second year, there is a higher rate of tax. But just imagine, you see, first of all, they have said that who can avail of this benefit. So they have ruled out, and I have no grievance with that. There is no reason why amnesty should be given to this class of people, those who have done money laundering or black money, or who have been victims of search, seizure. Even 2 years prior to that, they are not allowed. A survey, fine. In all these cases, requisition of books, you are not allowed, just as most of the amnesty schemes also do not allow you to do this. But then they say that if an assessment is done, or even if it is pending in your case, that means you have received a notice for scrutiny, you will not be able to go for this scheme. Now, please understand, you can file your return for 22-23 up to 31st December 22. As you know, under the provisions of the Income Tax Act, the notice under section 143 for scrutiny, if your case is to be picked up, has to be issued to you by 30th of June. So within 6 months from December, by 30th of June 23, you would get to know whether your case is picked up for scrutiny or not. Now imagine that it is picked up and it is not picked up. Suppose it is picked up, then your wisdom or sagacity that you want to get the benefit of the scheme is not going to work, because even if you realize this, doors are closed. And suppose you do not receive notice. You are a human being. What will your human nature say, instinct say? अरे बाबा अभी तक किसी ने पकड़ा ही नहीं, किसी को पता ही नहीं चला मेरी क्या भूल थी, क्या गड़बड़ थी, अब क्या पता चलने वाला है किसी को? Who will know about this? So why do, just as you have this saying in Hindi, "Aa bail mujhe maar," you would go on your own to the department 1 year or 2 years and say that I have to pay. And you know what you have to pay? Under the section 140B, if you are within that 1 year window, you have to pay all your regular tax plus all the interest. And though it is called as additional tax of 25%, that 25% additional tax would be 25% of the amount of your regular tax and interest thereon. And interest is under 3 provisions, 234A, 234B, 234C. So your regular tax and interest, if it was just regular tax, 25%, it would have been 37.5, you may still have thought. But if you take your tax and interest and 25% of that, and maybe you have to also pay the fee, that 5,000 if it's a belated return, etc. What is it going to be? You would rather say, come on, because I have received a notice, I can't do anything. And since I have not received a notice, why should I be overwise now and go to the department, and show all? And if it is beyond 1 year and up to 2 years, that will be 50%. So 45% tax and 50% of the amount of interest, etc. With all due respect, it is something like this. You have a door. You don't want to keep it open for a big list of people, so nobody can enter in. And when you keep the door open, those who have not received that notice within 6 months, why would they at all come within that 1 or 2 year periods? So with due respect, friends, this is very likely that this may become a flop show. A well-intended scheme will not work. There is constraint of time, but I'll go very, very quickly. I think I'll not refer to crypto tax because Bakul Bhai already mentioned, and we have no grievance about it. 30% is fine. We all wanted it to be taxed. There is a 1% TDS, etc., and therefore let that be taken care of. There are some very, very special provisions that have come in regard to assessment and appeals. Appeals, a good provision is that there will be a collegium of commissioners who will decide that if the department is trying to pursue an appeal to the High Court or Supreme Court, they may very well say that, okay, we will wait for an earlier year's order to come, or in a particular case the matter is pending, and we will. So with the consent of the taxpayer, I think this litigation and dispute management can be done well. It's a welcome scheme, subject to that the collegium is active and objective. On the assessment procedure, I have been one of the biggest champions and propagators of the faceless assessment scheme. And when you were not permitted the right of video conferencing, it was kept discretionary. My friends are aware that both under assessment and appeals, I used to say that, it's my right, and I cannot be deprived of hearing. Fortunately, the appeal scheme came, because it was challenged in the Supreme Court also, and then a statement was made. They built into that appeal scheme. Similarly, under assessment also, they have brought in this provision. There are some other small little changes, including, one in the favor of the department, that the assessment will not be treated as void merely because certain prescribed procedure is not followed. And courts have been taking a call that where procedure is not followed, it can be set aside and it can be redone rather than quashing it altogether. There are some small provisions in regard to reassessment. They are technical, so I'll not get into that. I think I'll take up the last point, and that is in regard to the obligations that have been widened in respect of tax compliance, because TDS, as I mentioned, you already have this provision of 194R, 10%. Similarly, they have brought in a provision, when you buy a property under section 194IA, there is a provision that you have to deduct TDS at the rate of 1% in case of value of a property, the sale consideration being more than 50 lakhs. Now, the provision that has been introduced is, because many a times, the stamp duty valuation may be, say, 54 lakhs. But just because you want to escape the TDS net and get out of reporting, you may decide 49 lakhs and 80,000. And then you may try to circumvent 50C lawfully in some other ways. But this was a loophole, so they say that now it will be 1% TDS on the sale consideration or stamp duty value, whichever is higher. So that is there. Then similarly, on TDS, they have also said that, you used to be given the status of a non-filer if you had not done it for 2 years. But if you are there doing it for 1 year, then now they say that even if you have not filed a return for 1 year and there's more than 50,000, etc., TDS in your case, then you will attract TDS at higher rates. These are some things which can be looked into. Friends, last two observations. I am not able to touch charitable trusts. There is a whole plethora of provisions in that regard. Maybe on a professional forum we'll discuss it sometime separately. But I would like to make a mention here, particularly in the light of this scheme that I mentioned, a flop show. I would say that ideally, what is the most practical and sensible advice that I can give to my taxpayer friends or even tax professional brothers and sisters. Please ensure, in Hindi I always say, आपको ये पता होना चाहिए कि आयकर विभाग को आपके बारे में क्या पता है. And therefore, the least that you should be doing before preparing and filing your tax return is go through thoroughly your AIS, Annual Information Statement. And if you have done that, and if you have filed your return, well, you need not even be required to become part of that flop show scheme. So the message is loud and clear. The government has a system. I always now even say hats off and salute to CPC. There is a wonderful person who is heading the CPC with a very dedicated team, a dear friend of mine, and I often compliment him because I know of cases, Bakul bhai, that you file your tax return and within minutes you get the intimation. And refunds you can get even in hours. There are instances of that. So gone are the days. I think, technology, artificial intelligence, the entire, the faceless scheme spirit, and all this together, that has given the revenue buoyancy, and we wish that that continues. And we really have a trust-based, voluntary compliance, litigation-free, a simple, a stable tax administration, and we would all be happy. But before I conclude, I have taken a couple of minutes more, but I would not want to end without this, because the finance minister referred to Mahabharat, and she also quoted saying that, the tax administrator must be taking a very objective view of things and not punish or put the taxpayer to pinpricks, for small things. Now, there is not a small, but a very major pinprick in this budget, for which I also want to make a mention before I conclude for the day, and that is under the provisions of Section 272 capital A, subsection 2. Friends, you are aware that this is a penalty that is levied for certain lapses on your part. And imagine, the kind of compliances that you are required to, completely unintended also, you may get into these traps. It's something like this, while you are driving a car, even getting a traffic challan sometimes is, you may have just crossed over 5-6 inches into that zebra, and the camera clicks and you get a challan. Now, the traffic department, of course, here in Ahmedabad, they are giving challans of 500. I don't know, some Ahmedabadi must have sent across this message. Under 272A2, for any lapses, and for each lapse individually per day, the penalty until now used to be only rupees 100. And now they say that our audit department says this 100 rupees is too meager. Kya hota hai? You said, no, what is 400, 500? So they said this 100 is too meager, make it 500. 5 times the rise in penalty. And I am mentioning this because you can become a victim of penalty for no fault of yours. Maybe it's your clerk or your accountant or somebody, or sometimes even because of Infosys. With due respect, I have nothing against them, but because their system does not work and I am delayed. There are a whole lot of penalties and people don't know. Notice of discontinuance of business has to be given within 15 days. If you have not done, per day 500 rupees. Your returns and statements for TDS, TCS, AIR, any response to inquiries, in case of charitable trusts, you are filing ITR 7, you don't have any tax to pay, but you have made a little, suppose your accountant is down with COVID and you delay it. Already you are paying 5,000 rupees late filing fee. But even otherwise, they say per day 500 rupees. 15G, 15H, because somebody is giving me, I have to give it to the department, per day 500 rupees. And what is most disturbing is, I've always been saying, even while I was on the task force, this is what I pleaded with, and it's part of our recommendations that we should do away with this. Now, under 26 AS and AIS, all my tax deductions that are made or tax collections that are made are captured on the basis of the statement. And if I file a statement belated, you already penalize me for that 500 rupees per day. But now imagine, a company which has to issue, say, 5,000 certificates of TDS in Form 16A for interest or dividend that it is paying to its depositors or shareholders. And for whatever reason, and what happens is now this certain jurisdictions, TDS authorities in particular, they know that you have downloaded a certificate only 15, 20 days later or 1 month later, and some people don't even download. Why? Because nobody wants to ask, no depositor or shareholder comes to me saying, please give me. They know because on their 26 AS or AIS it is already seen. So why do you want this paperwork? But the section, this outdated, obsolete section still continues with that. So just imagine a few hundreds or thousands of certificates to be issued, and you are not issuing it not because you don't want to, but because you want to conserve paper, and nobody wants that. They are happy with their 26 AS. Gone are the days when you had to attach them physically. But even for such most insignificant technical or venial default, 500 rupees a day. Friends, this frustrates the very objective of the budget presentation, saying that it is trust-based, it's voluntary compliance, it's simplicity. I'm not doing anything wrong. For what am I being punished and why? Forget my 5,000 rupees. In 8 or 10 such technical penalties, 5,000 rupees they'll take away from me. So the point is, if you are not able to give me something, at least don't take it away the wrong way. Even on the traffic lanes, okay, I must be disciplined. But here, for such technical and venial defaults, I think we all need, as taxpayers, citizens of this country, to raise our voice against this absolutely atrocious kind of a provision. I would like to conclude by saying and sharing this beautiful Urdu couplet, which says, कुछ ऐसे भी मंजर हैं तारीख की नजरों में, लम्हों ने खता की थी, सदियों ने सजा पाई है. Friends, such mistakes, such blunders of drafting in the act can create unparalleled, inimitable hardships, harassments, inconvenience. And let us all pray that at least in this year of Amrut Kal, if a taxpayer is not given the nectar or the Amrut, at least he is not given the wish or the poison of such atrocious penalties and such ridiculous provisions as in the case of Section 68 and cash credits. That is all that I am praying. Bakul Bhai, I am with you. Let the nation march forward. And as the Prime Minister himself said, let us look forward to India at 100. But then let us also consciously rise and stand up for any injustice, for anything wrong that is being done. While we salute the FM for all the good in the budget, all the tops, amongst the flops that you pointed out, these are also some of the biggest flops. These are some of the biggest, spining chills into the budget, which we must overcome. Thank you, AMA, my own alma mater, Ahmedabad Management Association, as we complete this 42 years. For me personally, it's been the 47th budget I've been analyzing since 1977. And Bakul Bhai, I look forward at AMA to completing the Golden Jubilee with you. Thank you. Thank you so much. And before I end, I would like to conclude. I think I would be failing in my duty if I were not to mention, we are always known as a trio. Bakul Bhai, Jainarayan Bhai, and myself. And we've been best of the friends over all these years. Our dear friend Jainarayan Bhai, because of some difficulties and challenges of his health, he could not join. But we wish him good luck, and he's always there in our minds. Bakul Bhai, we wish that whether the trio is together or not on the stage, we will be there together to voice out the concerns, budget after budget. Thank you. Jai Hind.
Thank you, Mukesh bhai. I think fabulous analysis, and I am already seeing in the chat box so many people complimenting and thanking. And I would say that, of course, one, we are all missing Jainarayan bhai. At the same time, we are all looking forward to that Golden Jubilee. Everybody, I'm sure, and curiously, maybe the budget is one, but the analysis of budget is more curiously or anxiously waited for by many of us, I would say. So thank you for the insights. Of course, I'm not going to repeat or summarize anything because that would not be right thing to do. But one thing that certainly feels like music to ears that Dr. Dolakia mentioned, Sir Bakul bhai mentioned, was there's a potential upside to this growth, and which certainly gives a fiscal space. And if certainly, and that thus the risk taken was worth it, which feels good that at least we are in the good regime, and coming here should be a good growth here. Thanks again for everybody to join, and certainly a warm thanks again for Bakul bhai and our own Bakul bhai and Mukesh bhai. Thank you so much for participating and presenting. Thank you.